Ladies and gentlemen, welcome to The Scoop. I'm your host, Frank Chaparro, Director of Special Projects at The Block, and I'm very excited to have back on the show, technically, we had a little bit of a snafu in Amsterdam, Sid Powell of Maple joining us on the program. They have a very exciting announcement, so we're just going to do a little wrap on what they've got cooking. No pun intended, given the Maple sort of. We're going to keep the pun going, right? The new product is Syrup-Fi, Maple, cooking.
Points programs, drips.
Drips. Oh, well, there you go. I love it. How have you been?
I've been good. I was going to say it's a redo, but first time making it to market with our interview. But it's good to be back. Thanks for having me.
I know. All good things happen to those who wait. So let's give a quick breakdown for people who are maybe unfamiliar to what Maple is because they didn't have the opportunity to listen to our great podcast that we recorded at Breakpoint. Give us the quick TLDR.
So Maple's an institutional lender. So we have been operating for about 3 years. We do loans to institutions on chain. So think directional funds, venture funds, trading desks, OTC traders, all on chain. What we've been doing a lot of recently has been over collateralized loans. So since Q4 last year, we've done about 180 million in loans to those types of firms, all over collateralized. And what we announced last week was Syrup. So Syrup is, think of it as like a permissionless DeFi access point to Maple's pools, which up until now had only been available to accredited investors in the space. So that's kind of the exciting update from our side. But yeah, DeFi lending space is what we're in.
Got it. So to an extent, does this open up the platform to non-institutional market participants, to retail participants who maybe are looking for an opportunity for some juicy yield?
It does. To continue the pun, they will have access to juicy yield. So the idea was, we feel like in the Maple platform itself, which has only been available to the accredited investors, we have pretty high quality yield. It's coming from very large, reputable institutions within the space. And then it has fairly good downside protection through being over collateralized, and with all that collateral generally being held with qualified custodians. So we've got all these rails in place. But if you look at the market this time around, there's hardly any retail participation versus what there was last cycle. And so what we wanted to do was create an access point for folks who may not be accredited investors, who are offshore from the US, but they want to access this type of yield. And we've got all the infrastructure there to make it possible, but we couldn't really, they couldn't reach us. And so there was a bit of a disconnect then for our community, where we have a lot of people who followed the project, but they couldn't actually use the pools. And so we wanted to open it up to them and give them a nice new product with which to do that. So that's part one. And the other thing that's probably worth noting is we couldn't get any DeFi composability. Like, we have these nice LP tokens that accrue yield. Everyone's been very big on kind of stable assets that are accruing yield this year. But you couldn't use it in AMMs. You couldn't use it as collateral. And so we wanted to open up those avenues for partnerships and collaborations with more DeFi native users, whether they be DAOs or other protocols.
How do you think this maybe reflects or ties into the broader evolution or maturation of crypto's decentralized lending market? How does it maybe mirror some other developments that you're seeing?
That is a really good question. I would say in one sense, it kind of diverges, and in another sense, it's converging with the other trends. But I'll just point out what we've seen in the market is it was more or less coalesced around a couple of very large protocols before. So you had Maker, Aave, and Compound being kind of the big three. And what we've seen is now, as the space has matured, newer entrants are coming in to compete. I think that one of the big entrants this year in the lending space was Morpho, who's done incredibly well in terms of their growth. And one of their models that I quite like is that they segregate their pools. So this is one aspect of maturing risk management where you segregate pools. And so on Maple, that looks like you have a high yield strategy and you have a blue chip strategy. And the blue chip is just very basic BTC and ETH backed lending. The high yield was using other forms of collateral. But we did that so that the pools didn't commingle risks. And Morpho, for their part, also did something similar where they have different risk managers running different pools. And I think in a similar sense that also protects participants in those pools where something goes wrong in one of the higher risk or in one of the different pools that you're not actually participating in. Whereas Aave, Compound were more monolithic structures. You had one pool, and that was also worth noting. That was kind of what the big CeFi lenders looked like. So BlockFi, Celsius, this was one huge monolithic balance sheet. And so when they had DeFi lending happening in there, or DeFi yield farming in the case of Celsius happening alongside the over collateralized loans, it exposed you to risks that you didn't realize you were taking before.
So to sum it up, I mean, it sounds like the decentralized lending space is looking at different ways to de-risk.
Yes, I think that's probably the most important observation, to de-risk. And also, I think one of the things that we're seeing come back is this idea of composability. You've got an LP token. I mean, you can see this less so directly in lending, but if you look at protocols like Athena, I think one of the things they've done very well is partnerships and integrations with other ecosystems, whether it be the Morpho plus Maker or Morpho plus Spark plus Maker tie-up that they have going. And what we would hope to achieve is that if this launch is successful, then you'll see the LP tokens from Syrup get used in other protocols, whether it's an AMM so that you can get instant liquidity and get out of your exposure, or putting it in, using it as collateral to borrow so that you could loop it. I think that's where you start to get network effects. And that's something we kind of didn't really have before, but which I think the successful projects have.
And how does sort of opening this access up to different types of market participants help maybe enhance the robustness of the overall ecosystem and the sort of counterparty risk that underpins it?
The two go hand in hand. So if you look, if I'm trying to increase the robustness of the ecosystem, I'd say it's a little bit like the resilience to shocks, right? And so hand in hand with that, if you are more concentrated among a smaller number of participants, then you're less robust to shocks. Because if you're dependent on one major participant providing all your liquidity, if they go, your protocol's going to struggle. And so I'd say one aspect of robustness to shocks is we want to have a larger number of smaller participants on Syrup. Whereas with core Maple, the product that's only available to accredited investors, we tend to have larger institutions. So we've got a smaller number of participants, but larger check sizes. Whereas with Syrup, we're going to open it up and hopefully, if successful, have many, many more smaller participants, all geographically spread out around the world. And so if we execute on that, then if there is an exogenous shock, or let's say some event happens in DeFi, we're not going to see everybody react the same way at once, and we'll be more robust to those shocks. So that is one aspect I would say. The other one is if you can connect applications or dApps. So Athena got Maker in via Spark and Morpho, and Maker is a very large balance sheet, but they're also likely to be stickier capital. They're not going to be so flighty. And so I would love to see large participants like that using Syrup and being a stickier client or user who has a longer time horizon. So in that way, again, we're going to be diversifying our customer base, but having a set of clients who are not going to be, flighty, like we all saw what happened when depositors get flighty with Silicon Valley Bank, for example. And so that is a real thing you have to concern yourself with.
How do you sort of gauge the credit worthiness of these new market participants? What is to prevent a whole large swath of non-credit worthy market participants from flocking to something like this?
So you always have an adverse selection issue when you're a lender. In this case, though, Syrup is only going to be doing over collateralized stuff. So your counterparty risk is much smaller because you've got the collateral from them, and you're also using custodians for that collateral. So it's not, it's quite different from what was happening in 2021 and 2022 when you had much more uncollateralized lending. My broad comment on leverage in the space at the moment is that we're probably only at, maybe 10 to 15% of the level of leverage that we saw in the system last time. So there's far less overall borrow and lend, and much, much less uncollateralized or unsecured borrowing and lending going on at this, at least at this stage of the market cycle. And so I think even though you might get approached by less creditworthy borrowers, as long as we're always taking about 140% collateral from them, we really mitigate the risk, and they also self-select out of this process. So this is largely going to be large OTC desks, directional funds, but generally larger in size, and it's not going to be permissionless borrowing. They still have to go through KYC and financials checks.
You mentioned that you'd say the market right now is about 10% of where it was at the peak of the last crypto credit boom before it went bust. Obviously, you mean aggregate of DeFi and CeFi lending. What about DeFi specifically? Are we sort of just flatlined, or is it also less than it might have been back in those frothy Haslion days of 2021?
DeFi lending, I would say, is also below where it was in those days. I think Aave's the largest lending protocol by size. But if you look, so Aave and Maker are probably the two comparable ones. But if you look at the rest, most of them are down quite significantly from where they were at that point in time. And also, you have a lower number of participants. So a lot of the DeFi lending protocols kind of went defunct or inactive in that time since then. And so it's been more acute in CeFi, but it's definitely quite pronounced in DeFi that there is far less lending than there was at that point in time. And I think it's probably, again, a function of like the market has not yet kind of passed, or has not really moved significantly beyond the previous all-time highs. But my expectation is that we will see an upleg in the second half of this year. And so that, I think, will trigger a wave of new lending and borrowing activity. And I would also say people are definitely getting more risk on than where they were last year. So this time last year, when you and I recorded our abortive interview in Amsterdam, the risk appetite of lenders was like half of what it is now. But at that point in time, people only really wanted T-bill yield. Now already, when I offer a T-bill yield product or a BTC-backed loan product, the BTC-backed loan product is far more appealing for them because they can get 11%, and they view that risk as quite manageable. So if you look at that is an anecdotal evidence of more risk-on appetite among people who are holding capital. And that includes corporate treasuries as well. So you see corporate treasuries are now interested in that yield product, whereas no way would they have looked at this last year.
Yeah, I think that's a fantastic point. And if you think back to, or if I think back to, and I'm sure you probably will recall as well, to October, that is when the winds were shifting, so to speak. And I remember, and I have it here in my notes for the convo, there was a article in Bloomberg reporting crypto exchanges in this is so funny to think in October they were in an existential struggle. Coinbase stock was probably not doing as great, but I mean, if they had written this article a month later than they did, it would have been a different story. But yes, in this existential struggle that they were in October, now they're doing quite fine. They were embracing lending. And so I remember even probably over the summer, right, Coinbase and Kraken and others leaning into their lending books. Still, I mean, obviously, I think October and November were a bit of a turning point, not just for the market, but for these businesses and for crypto lending. It still doesn't feel like it's quite ramped up in any significant way. And is it a demand side problem or a supply side problem? In as much as at least I get the impression, and then I'll stop pontificating ad nauseum, the exchanges or these other centralized players almost are so quiet about it. And I get the sense, at least, that either it's from a regulatory perspective or from just the perspective of we don't really want to take on any more of this business because it's either A, too risky, or B, we really want to approach it with caution. What's your sense? Because I don't know. I know that you want to grow Maple as quickly as possible. I think that DeFi, again, still very, very small. You can only take up so much of the pie. You can't go full throttle and be the size of Genesis tomorrow, although I'm sure you would like to. But you would think that one of these centralized players could go after that. But they haven't necessarily done that. Anyway, long-winded question, I guess, to put a finer point on it. Why do you think no one's filled that gap? Is it because there isn't demand, or because of this sort of friction or fear, maybe this cautionary approach that I described?
It's a good question. The short answer is I think it's supply side constrained, but it's also too fundamental a shift in business model for these centralized exchanges. Coinbase, I believe, has so far executed the most successful lending business line internally. Binance, I know, is a big lender as well. So functionally, all centralized exchanges lend to their market maker clients. Generally, it's at a below fair market cost of capital because they're trying to subsidize trading volumes. So if you look at it, if I owned the marketplace, I would lend people the money to go and trade in my marketplace because I make the money back on the trading fees, and it also supports my valuation when I want to go do the next equity round as an exchange. So those are the reasons why they do it. But it's not my primary business line. My primary business line is generating returns through trading activity. And if I'm also an exchange, let me just put myself in, say, Binance's shoes or OKX, or KuCoin, any large ones this applies to. Would I want people knowing that I lend at scale? Because then people might be concerned that what if I have a default and don't tell people, and then I always risk having a run on the bank, so to speak, which was, of course, ultimately what sunk FTX. Like, there's odds that it wouldn't have been discovered if Binance hadn't gone and sold all the FTT tokens and triggered concerns around the liquidation of Alameda's loans. And so that's something that I would be super mindful of if I was a centralized exchange, that perception that could trigger a run on the bank. But also it's a different set of skills. Like, most of my money as an exchange comes from either my balance sheet, which is my own equity capital and returns on trading, plus client funds that are deposited. And for me to then go and raise money to go and lend that money out, it's a different set of clients I have to find. And if I lean in too far to that business, I risk just becoming, BlockFi or Celsius again, albeit with an exchange attached. So I think not necessarily one reason, but like 2 or 3 big reasons. So different business model, risk of run on the bank, and also it's less profitable for them than just outright trading.
Yeah, I mean, it kind of boils down to a bit of risk, or just this idea of not opening yourself up to too much risk. So walk us through then the playbook for Maple specifically. Is it more about trying to capture market share within this DeFi space, or somehow growing the pie?
Short answer is grow the pie. So yes, in the first instance, we want to take some more market share in the DeFi space. I think we've positioned ourselves as kind of a hybrid between DeFi and CeFi. If you look at it, all the loans are verifiable on chain. They go out via smart contracts, but then the collateral, we are integrated with qualified custodians. And that actually becomes a feature rather than a bug for a lot of borrowers we deal with. They have a GC, they have a compliance officer. They don't necessarily want to put millions of dollars of BTC, first wrap it and then put it in a smart contract. So knowing they can park it at Anchorage or BitGo has been a major plus in terms of winning that business. So with that in mind, what we want to do is start to grow the pie and try and capture the people who are perhaps on the fringes of DeFi, and they might want to deposit in fiat, or they might want to receive an interest statement that they can show their auditor rather than purely interacting with a protocol. And so I think that's kind of guided our strategy this year, and it seems to have been really successful. We grew by over 130 mil since the start of the year to about 200 mil TVL. And ultimately, the 5-year vision for Maple is, we kind of want to be like the Apollo of on-chain lending. So, initially focus on digital assets. That's our wedge, and then we'll grow that and see how large it can get. But we do want to get, you mentioned before, getting as large as Genesis. That is our aim. Go there and then continue growing. And Syrup, as a strategic play, is to open us up for more DeFi integrations and a wider audience than just those accredited investors within the US. DeFi is global, and currently we're not quite reaching them, but we will with Syrup.
Awesome. Well, appreciate you taking the time to join the program.
No, thanks for having me. It was a pleasure to be back on.
Of course, and we'll have you on again soon. We always love talking credit and lending here on the show.
Hopefully in a positive light, no blow-ups.
No blow-ups. Yeah, I mean, it's too small to blow up. We got to get back to the
the halcyon days.
Yeah, to the halcyon days, so that we can have a spectacular blow-up once again. I mean, it was insane how everything was so insidious.
Well, look, risk is, Mark Twain once said, it's not what you don't know that hurts you, it's what you know for sure that just ain't right. And so I look at some of the things we're looking at the moment is like, would we consider, and we are evaluating, but would we consider like LRTs, liquid restaking tokens, as collateral? And I think one of the things I look at with kind of apprehension there is that everybody is convinced that they are risk-free. And that's of course where you get blow-ups, is when you overextend yourself based on something you believe that doesn't end up being true. And so that is also a hidden source of leverage in the space, right? The more restaking that occurs, that's rehypothecation of assets.
In one sense, yeah. And I think it is it is what we take for granted sometimes, or what we think or know to be true, like FTX being solvent, or Three Arrows having the money.
Yeah. Or 20% being a risk-free rate.
Well, if you don't know where the yield's coming from, then you are, I suppose.
Yeah.
Talk to you soon.
All right. Thanks, Frank. Appreciate it.